So what are interest-only loans? A home loan repayment typically consists of two parts: principal portion, which is the amount you borrowed, and the interest portion, which is what the bank charges you for borrowing the money. With an interest-only loan, you're only making the minimum repayments based on what the bank is charging you to borrow the money. And the principal portion does not actually get paid down. Therefore, your loan will always remain the same. For example, if your loan is $500,000 with interest-only repayments for 3 years, after the 3 years, your loan will remain at $500,000. So why and when is it needed? Generally, you would want interest-only repayments if the property is an investment, or if you have plans to convert your current owner-occupied property into an investment. It's a way to maximize your tax deductions as a property investor. Especially if you already have an owner-occupied loan, it is recommended that you focus on paying down that portion of the loan first, before paying down your investment loans. You might be thinking to yourself that you want to pay down all your loans. Yes, you're not paying down your investment loan, but you have to remember, as an aggregate of your total loans, investment and owner-occupied loan, you're paying down your debts. It's just a matter of which loan you should focus on paying down first. So how does interest-only loans benefit me? It could be for a few reasons. Better cash flow because I'm renting. Better cash flow because my investment property is highly negative geared. Better cash flow because I have an owner-occupied property that I want to pay down first. Or it could be the principal portion not paid down on the investment loan could be reinvested into stocks or other asset classes. It may even give you better cash flow to be able to buy a more expensive property to invest in. For example, for $800,000 loan at 3.5%, principal and interest repayment is $3,593, while with interest-only repayment, it's $2,334. Therefore, if I rented out the property and received $2,200 per month after all associated costs, the rent received should be able to cover majority of the interest-only repayments. However, if I paid principal and interest repayments, I would have to pay an additional $1,393 out of my own pocket per month, which may affect my cash flow, or I can refocus this extra money into my owner-occupied loan instead. So here is an example. Let's say your investment loan is $800,000 at 3.5%. However, you also have an owner-occupied loan of $500,000 with 25 years remaining and paying 3%. By refocusing the extra $1,393 per month in additional repayments into your owner-occupied loan, you can potentially reduce your loan term from 25 years down to 14 years.